All right, so my next guest bought Palantir, get this, June 2023 at $15 a share, and he continues to own the stock. In fact, I guess that's how you make Barron's top 100 independent financial advisors 16 years in a row. I want to bring it out Mainstay Capital Management CEO, Chief Investment Strategist, David Kutla. David, first of all, what made you buy the stock in the first place? I remember for a while there, it felt like it was a cult stock, right? Everyone who loved it, whenever I would ask why they loved it, they just loved it, right? The criticism on Wall Street was either that it was opaque or there were too many retail investors in the stock. But you bought it and you still hold it.
Yeah, well, when you look at what Palantir does and you look at the world we live in today, it's like Tesla. It's a stock or a company with a story. They're a company that's winning in AI right now. They're not hoping on the future. They're winning in AI right now with their AIP platform and what they've done in anti-terrorism with everything going on, all the conflicts around the world. It is a story stock that has tremendous earnings, a fortress balance sheet, and we should continue to like the stock.
So there's a large camp out there, people who are. It's ironic you mentioned Tesla, right? Because I think Alex Karp is going to grow into a Main Street figure beyond the stock market. But many are saying, hey, the guy's too opinionated. His ideas are dangerous. What do you say to those people?
I say they're wrong. I say that Alex Karp is a patriot. He represents the patriots in this country. And as an American, he makes me feel better about being in this country. And he makes me feel safer. You know, when you hear him talk, he talks about how this company helps our government and other governments around the world defend against terrorism, defend against in conflicts. And so it's a company that makes me feel better and safer as an American.
Let's talk about the U.S. economy. I read that you're looking or anticipating stagflation light. Yeah,
you know, we think that if we look at our setup now, you know, coming into 2025 and what we expect going forward, I mean, we just had a negative 0.3% GDP print. There's some extenuating factors in there with imports and so forth. But right now, you know, when we're looking forward at PCE, the Fed's preferred measure of inflation, it's expected to go higher through the year, now below 3%, expected to go above. Unemployment at about 4.2%, expected to go to 4.6%. And the economy is slowing, that's for sure. So in that environment, those are the three ingredients for stagflation. And so we don't think it's like the 1970s. It won't be something that bad, you know, but our base case is for a stagflation light, if you will.
So in the meantime, on the broad markets, there have been a major flight of foreign money out of the U.S. And I know that you also have been more focused on investing out of the U.S., right?
Yeah, you know, if you look at our portfolios compared to this time last year, our allocation abroad is as much as 3 times where we were last year. And that's really, we're tactical asset allocators, Charles, so that's a tactical opportunity in places like Europe, where they're spending more on defense. That's going to be huge fiscal stimulus for the EU, where we have, if anything, fiscal austerity here with DOGE and what's happening, you know, in cutting back in government spending. The ECB eased at their last meeting. They're going to continue easing. The Fed is not going to ease on Wednesday, and I think it's questionable how much they'll ease in the second half of the year. So from a fiscal and monetary standpoint, lower valuations. Europe's attractive, and some other markets are as well, just on a relative basis. We still like the U.S., but we've got opportunity abroad, and that's what we want to take advantage of.
All right, well, you've made the list 16 years in a row, so you kind of have a feeling what you're doing. Hey, David, great to see you. Talk to you again real soon.
Thank you. Good to see you, Charles.